Assalamualaikum. We are from Group 7 and we will explain about the topic 6, which is a fund management in foreign exchange market.
Assalamualaikum. My name is ELIZA HANIM HAKIMAH binti JAMAN, metric number 261799. Now, I will present the first subtopic for topic 6, which is borrowing and investing without an exchange position. Introduction of foreign exchange market. Foreign exchange market, more commonly known as Forex, is a global market for trading currencies. It handles a huge volume of transactions 24 hours a day, 5 days a week. Another meaning of Forex is the market in which people or firms use one currency to purchase another currency. There is no centralized location for the Forex. Major trading centers are located in New York, Tokyo, London, Hong Kong, Singapore, Paris, and Frankfurt, and all trading is by telephone or over the internet. Businesses use the market to allow them to buy and sell products in foreign countries. However, most of the activity on the Forex is from currency traders who use it to generate profits from small movements in the market. To get a sense of this, it is useful to consider 4 groups of people or firms who participate in the market. First, firms that are involved in international trade of goods and services. Second, tourists visiting other countries. Third, international investors buying ownership or part ownership of a foreign firm. And fourth, international investors making financial investments that do not involve ownership. Next, the benefits of trading in Forex. There are 3 benefits of trading in Forex. The first one is liquidity, second accessibility, and open market. For liquidity, because of the size of foreign exchange market, investments are extremely liquid. International banks are continuously providing bid and ask offers, and the high number of transactions each day means there is always a buyer or a seller for any currency. Second, accessibility. The market is open 24 hours a day, 5 days a week. The market opens Monday morning Australian time and closes Friday afternoon New York time. Trades can be done on the internet from home or office. The last benefit is open market. Currency fluctuations are usually caused by changes in national economies. News about the changes is accessible to everyone at the same time. There can be no insider trading in Forex. What is exchange position? In any transaction, there is always have with or without exchange position. Generally, it is like the cash inflow and outflow of the account. The exchange position or currency position of a bank is the position from its day's purchases and sales, both ready and forward, of foreign currencies. The position of book is a banker needs and also required to under the exchange control regulations to maintain proper records of his sales and purchases of foreign currencies, both ready and forward, separately for different currencies in a position book. There are 2 components of exchange position. The first one is the transactions that go into the composition of the exchange position in a given currency are the sales and purchases in that currency for which a firm, especially a bank, rate has been quoted, irrespective of whether such transactions have been completed or not by the delivery of the currency. Second, in determining the exchange position, the sales and purchases are to be classified into separate groups. Together with the short or long position, the resultant balance gives the exchange position. Transaction without entering foreign exchange market. The position is generally termed open. When the sale and purchases equal each other, the position is said to be square. When explaining about borrowing and investing without an exchange position, the bank no need to enter foreign exchange market and buying the amount of foreign currency needed using currency or money owned. In Forex, when you buy, you also sell simultaneously. For example, when bank buy dollar using Ringgit Malaysia, MYR, the bank will long dollar but short in Malaysia Ringgit. In without exchange position, also, the bank use long in US dollar when receiving dollar from USA to swap with short in dollar when make payment in dollar to Singapore bank as an example. For brief example, if bank expecting to receive payment from USA with an amount of $1,000 at 13 May 2021, for example, and in the meantime need to make payment to Singapore bank with an equal amount, so for this, no need for Malaysian bank to enter into foreign exchange market in order to gain $1,000. This is said to be square off position, so the conclusion is it will show the result square off position. The last part for this subtopic is I will explain about short and long position. In the foreign exchange market, an investor simultaneously goes long on one currency, which is the currency they buy, and short in the other, which is the currency they sell, whenever they open a trading position. Short position is when the sales of a day exceed the purchases. The position is known as oversold or short. Whereas for long position, when the purchases of a day exceed the sales, the position is known as overbought or long. To go long on a certain asset means to buy and hold that specific asset in the expectation that its value will increase so that it will be sold at a profit. A banker aims at netting a profit, but in so doing, he must not get involved in speculative overbuying or overselling. To avoid holding an open position, the banker should, and as matter of fact, immediately cover a forward transaction by a reserve, sale, or purchase of the same currency. This is done because there is risk in an open position in case there is devaluation of the particular currency. The last part is the definition of position in foreign currency and balance. Position in foreign currency is net difference between the total sales and purchases of that currency on a particular day, and balance refers to the balances, debit or credit, of the nostro account of a bank in that currency with its overseas branch or correspondent.
Assalamualaikum. Hi, my name is NURUL NAZIRA binti Nazir. My matric number 26453X. Okay, I will explain about what is borrowing and investing with an exchange position. Okay, what is the borrowing with exchange position? Okay, I give two example, which is currency swap and back to back loan. Okay, what is the currency swap? Okay, currency swap is an agreement in which two parties exchange the principal amount of a loan and the interest in one currency for the principal and interest in another currency. Okay, how to it work? Okay, at the inception of the swap, the equivalent principal amount are exchanged at the spot rate. Okay, during the length of the swap, each party pays the interest on the swapped principal loan amount. Okay, at the end of the swap, the principal amount are swapped back at either the prevailing spot rate or at a pre-agreed rate, such as rate of the original exchange of principal. Okay, using the original rate would remove transaction risk on the swap. Okay, the currency swap are used to obtain foreign currency loans at the better interest rate than a company could obtain by borrowing directly in a foreign market, or as a method of hedging transaction risk on foreign currency loans which has already taken out. Okay, currency swap can also involve exchanging to variable rate loan or fixed rate borrowing for variable rate borrowing. Okay, the second example is a back-to-back loan. Okay, back-to-back loan is when two companies in different countries borrow offsetting amount from the one another in each other's currency as a hedge against currency risk. Okay, how to it work? When a company need access to money in another currency, it raise for it on the currency market. Okay, but this is because the value of some currencies can fluctuate widely. A company can unexpectedly wind up paying far more for a given currency than it had expected to pay. Okay, companies with operation abroad may seek to reduce this risk with a back-to-back loan. Okay, one example would be an American company wishing to open a Europe office and Europe company wishing to open an American office. Okay, the American company may lend the Europe company 1 million for initial leasing and other costs. Okay, this loan is calculated in US dollar. Okay, the Europe company lends the American company the equivalent of 1 million in euro at the current exchange rate to help with its leasing and other costs. Okay, this is because both loans are made in the local currency. There is no currency risk when the loan are paid back. Okay, what is investing with exchange position? Here have two examples, which is a foreign bond fund and multinational cooperation. First example is the foreign bond fund. Okay, there are mutual fund the invest in foreign government bond which an interest dominated in the foreign currency. Okay, if the foreign currency goes up in value relative to your local currency, okay, the end interest increase when converted back to local currency. Example of such fund include the Hard Currency Fund, Aberdeen Global Income Fund, and Templeton Global Bond Fund. Okay, the second example is a multinational corporation. Okay, many stockholders indirectly participate in the foreign currency market through their ownership in companies that do significant business in foreign currency. Okay, some of the better known American companies with overseas exposed Coca-Cola and McDonald's. Okay, the revenue and profit derived from overseas operation are boosted if the foreign currency appreciate versus the dollar. Okay, this is because those revenue are converted back into dollar for financial reporting purpose, and a strong foreign currency will yield more dollar in exchange.
Assalamualaikum. My name is NAZUHA binti JAMAL. Matric number is 26180. Now I will continue with the third subtopic in topic 6, which is manage opposite cash flow in different currencies or foreign exchange risk management.
Okay, next is manage opposite cash flow in different currency or foreign exchange risk management. What is foreign exchange risk? Foreign exchange risk, also known as exchange rate risk, is the risk of financial impact due to exchange rate fluctuation. The problem of foreign currency fluctuation have high level of occurrence in cash flow that consists of several different currencies. The type of foreign exchange risk and their example is I discovered three types of foreign exchange risk, which is transaction risk, translation risk, and economic risk. Transaction risk is the risk that faced by a company when making financial transaction between jurisdictions. The risk is the change in the exchange rate before transaction settlement. Essentially, the time delay between transaction and settlement is the source of transaction risk. The transaction risk can be mitigated using forward contract or option. For example, a Canadian company with operations in China is looking to transfer yuan 600 in earning to its Canadian account. If the exchange rate at the time was 1 Canadian dollar to 6 yuan, and the rate subsequently falls to 1 Canadian for 7 yuan before settlement, and expected receipt is Canadian 100 instead of Canadian 86. The second one is economic risk. Economic risk is the risk that companies' market value is impacted by unavoidable exposure to exchange rate fluctuation. It is usually created by macroeconomic conditions such as geopolitical instability or government regulation. Example of this economic risk is a Canadian furniture company that sells locally will face economic risk from furniture importers, especially if the Canadian currency unexpectedly strengthens. And the third one is translation risk. Translation risk arise from translation into the domestic currency for accounting purpose of amount which are denominated in a foreign currency. Translation risk is higher when a company holds a greater portion of its assets, liability, or equities in any foreign currency. Some example of translation risk is a HQ company that reports in Canadian dollars but overseas a subsidiary based in China face translation risk as the subsidiary's financial performance, which is in Chinese yuan, is translated into Canadian dollar for reporting purpose. The next one is how to manage exchange rate risk. The first step is we need to avoid all risk exposure. Risk exposure is the measure of potential future loss resulting from a specific activity or event. An analysis of the risk exposure for a business often ranks risk according to their probability of occurring multiple by the potential loss if they do. By ranking the probability of potential losses, a business can determine which losses are minor and which are significant enough to warrant investment. There are two categories of risk, which is the pure risk and also speculative risk. And the second one is we need to reduce risk exposure to minimum through internal hedging. Internal techniques to manage forex risk should always be considered before external methods on cost grounds. Internal hedging methods are those available within the business itself. This typically should always be considered before resorting to external method as they can be cheap and relatively straightforward. These include invoice in home currency, leading and lagging, and also matching. Okay. Invoice in home currency can be defined as a business can transfer all the foreign exchange risk to their customer if the invoice in euro. However, this may result in lost sales, especially if they are in competitive industry. Customer may not want to have foreign exchange risk exposure. Second is leading and lagging. Cash flow management methods whereby the business will seek to pay or receive foreign currency denominated payments or receive early or later depending on the expected movement in foreign exchange rates. And the third one is matching. Matching is when a business has income and expenditure in a foreign currency, then it can operate a bank account in that currency and match them against each other, removing the need to translate them all back to euro first. The business then only needs to translate the surplus back into euro, saving on transaction costs. The third one is hedging risk exposure. Hedging simply means that you use specially designed financial instrument to lock in the foreign exchange rate so that it remains the same over a specific period of time. There are numerous ways to hedge, but as an exporter, you are most likely to use a foreign exchange facility which can obtain from bank. And the fourth one is take on risk exposure head-on. Next slide is about how bank trade in foreign exchange. A bank dealer may trade in the foreign exchange market subject to strict compliance to the guidelines set by his management. These include the size of his open position. For example, the short or long position is allowed to hold at any point of time. And the second one is the point at which when the prevailing rate is not in his favor, he has to unwind his foreign exchange position and accept a loss. Unwinding also refers to the correction of a trading error, since correcting a trading error may be complex or require multiple steps or trade. For example, a broker mistakenly sells part of a position when an investor wanted to add to it. The broker will have to unwind the transaction by first buying the sold share and then purchasing the share that should have been purchased in the first place. The third one is the size of his exposure with a particular counterparty, and the fourth one is the size of his exposure in a particular currency for a particular settlement date.
Assalamualaikum and very good evening. My name is SHAFREENA. My metric number is 258990. Here I would like to present about fund management exchange control. This defined as managing cash by overseeing and handling financial institution, cash flow under government imposed limitation on the purchase or sale and of currency. For example, import and export, which that the government put an quotation in buy and selling between two currency. The importance of fund management regarding the financial health of the entire banking industry. That shows the equivalent of demand and supply with the transaction of buy and selling process. This means that the higher the demand and supply, it makes the financial health more stable. And second one is manage cash and prevent the asset liability mismatch in the cash flow. As we can see, if the fund management exchange control is weak, it can make or causes like fraud, money laundering. So that by managing fund management exchange control, it increase GDP. There is three types of fund management. The first one is mutual funds. Mutual fund defines as types of investment that consists of a portfolio of bond such as like securities and bond. Second one is trust fund. Trust fund is the tool that establishes the legal entity that to hold property asset in organization. The last one is financial statement analysis. This is to evaluate the company performance through income statement, balance sheet, and statement of cash flow. There is two methods under exchange control. The first one is unilateral method, and the second one is bilateral method. Unilateral method means that the government apply exchange control without consultation other government, such as exchange pegging, standstill agreement, compensation agreement, payment agreement, foreign exchange rationing, blocking of foreign exchange. The last one is bilateral method. Means that a government applies exchange control with the mutual understanding and consultation with the other government, such as cleaning agreement, moratorium, and moratorium application.
Assalamualaikum and hi, my name is ATIKAH binti DAUD, material number 264451. I will explain about the type of contract in fund management in foreign exchange market. We have a four type of contract, which is a swap contract, forward contract, option contract, and spot contract. The first one is a swap contract. Swap contract is a agreement between two counterparties to exchange a financial instrument or cash flow or payment for a certain in time. This instrument can be almost anything, but most swap involve cash based on national principal amount. Swap contract have three types, which is the first one is interest rate swaps. The second is currency swaps, and the third one is hybrid swap. Interest swap is a interest rate swap allow their holder to swap financial flows associated with two separate debt instruments. Currency swap is allow their holder to swap a financial flow associated with two different currency. And hybrid swap is allow their holder to swap financial flow associated with a different debt instrument that are also denominated in the different currency. Okay, now I will explain about the second contract, which is a forward contract. Forward contract is an agreement between two parties to trade a specific quality of asset for a specific price at a specific date in the future. Forward contract are similar to future contract, but there is a key difference, which is the first one is in term of contract. Forward contract has a higher counterparty risk. Meanwhile, the future contract have a cleaning house and it's lower counterparty risk than the forward contract. The second one, in term of expiry date, forward contract, since they settle on a single date, so they are not commonly associated with initial margin or maintenance margin. But in the future contract, they have associated with the initial margin and maintenance margin. And the last one is about settlement. Both are involved in delivery asset, but in forward they usually use physical delivery more common, but in future they are used as cash settlement more common. Third contract, which is option contract. Option contract is an agreement between two parties to facilitate potential transactions involving asset at a future price and date. There is two type of contract, which is a put and call option. Call option can be purchased as a leverage bet on the appreciation of asset, while put option are purchased to profit from the price decline. Buying option offer the right but not the obligation to purchase or sell underlying asset. Last contract, which is a spot contract. Spot contract is a buying or selling commodities, security or currency for an immediate settlement on the spot date. This normally take a 2 business day after the trade date. The settlement price is called as a spot price. Spot price depend on the item being traded. Spot price can be indicates market expectation of future price movement in a different way. Spot price will reflect the supply and demand, not the future price if the cost storage higher than the expected future price of the commodities. Meanwhile, the spot date is a normal settlement day when the transaction is done today. It normally take 2 banking days forward for the currency pair. A transaction has a settlement after the date is called a forward contract. For a trade with to date, such as a foreign exchange swap, the first date is we take as spot date. Thank you for listening to our explanation.